Despite all the doom and gloom of the global economy, there's one area where optimism is the name of the game: venture capital. In recent years, the venture capital landscape has seen unprecedented growth, with record amounts of capital flowing into innovative startups across various industries. From tech unicorns disrupting traditional markets to biotech companies revolutionizing healthcare, venture capital investors are betting big on the next generation of groundbreaking ideas. It's not the easiest thing to understand, which is why we dedicate this episode to speaking to an expert who believes 2024 will be a good year for venture capital. That's our topic of discussion here on Put Simply this week. I'm your host, Erdem Koch.
And I'm Ozan Ibrahim.
Welcome to Put Simply. Ozan, good to be back. Episode number 8 for Put Simply. I'm going to be honest, my friend, I didn't think we'd necessarily last this long, but a pleasure being on the podcast with you again.
Thank you very much, Adam. And yes, I'm with you on this one. I'm very pleased that we've lasted this long, but somewhat surprised. Look, I think first of all, I think we're having a lot of fun doing it. There's the more and more we do it, we kind of find out there's a lot of issues that people are actually quite interested in knowing more about. So yeah, we'll keep it going and get some more interesting guests for the episodes and look at some interesting topics. Today's topic is quite interesting. I think it comes from both of us being confused about some of the things that we've read recently about certain aspects of the economy almost going to overdrive or kind of into turbo or about to go into turbo speed.
It definitely is interesting because the talk of the last, let's say post-COVID, right, post sort of lockdowns has been high interest rates, inflation, cost of living, economies under pressure all around the world. What's really interesting is what we're seeing in not only the traditional stock markets, in the cryptocurrency space with everything that's been happening with Bitcoin surging to an all-time high in sort of the last week or so. What's really interesting now is when you look to venture capital, and we'll unpack what venture capital means. Our guest today is of the strong belief that actually there's more money than ever before, and there's a lot to be spent and a lot of startups to be invested in. And that to me was really interesting when we first met Felix and had that conversation with him, because we thought, well, hang on a second, doesn't that go against everything that we've been hearing in the news, not only in the, let's say futuristic, economic space and startups and companies that are, likely to come onto the sort of the public arena, if you like, in the next few years. It goes against all of that, plus the traditional headlines. I mean, the question has to come of, well, what is actually happening in venture capital? And, can someone put it simply? And well, we've got the perfect guest to do that for us this week.
Look, there seems to be a complete disconnect between what we're hearing coming out of the US. I think it's fair to say that the US is in quite a strong recovery mode, has bounced back from the last year of high inflation. But I've got to say, I'm not talking to anybody that's all that excited about this economy. Last week, I think the UK, if I'm not mistaken, dipped into a technical recession. Where I'm based in Asia, when you're talking to investors or others within multinationals, everyone's quite concerned about the next 3-6 months of earnings. But yeah, it's very interesting that we're seeing some light out of all of the kind of doom and gloom that we're seeing in the headlines outside of the US.
Well, let's bring our guest into the conversation this week. Now, Felix Kuz is a top venture capital voice on LinkedIn. He's been in this space for a very long time. He's a general partner and founder of Aurelia Ventures, which supports early stage B2B SaaS founders in the US and has been doing so for the last 4 years. He spends a lot of time in Silicon Valley and is extremely optimistic about the year ahead in venture capital. He's our guest this week on Put Simply. Be sure to follow us on our LinkedIn page, Oroka Group, to ensure you're up to date with all the episodes of Put Simply. And feel free to leave a comment on any of the podcast episodes there, or even leave us some tips on who you'd like us to speak to and what you'd like to speak us about here on Put Simply. But this week, it's all about venture capital, and our guest here is Felix Kuz. Felix, welcome to Put Simply. Could you tell us a little bit about yourself and what it is that you do?
So I'm the GP and founder of a venture capital firm and accelerator called Aurelia Ventures. We're focusing on very early stage AI B2B companies that work with enterprise or the US government And we invest in them and we help them as well to scale and to grow for the first 2.5 years of their life cycle. Usually we start working with them around the idea, stealth, POC stage, however you want to phrase it, and helps them to grow until they have raised the seed round.
Felix, you mentioned a lot of terms there that I really didn't understand. We're going to get to those, as that's the point of Put Simply. But before we do, I watch a lot of Netflix, and I know that Silicon Valley is full of 20-year-old billionaires sipping chai lattes all day on their colorful bean bags, playing their gaming tournaments. Considering that you spend a fair bit of time there, could you confirm that, or actually tell us what it's all about?
It's actually exactly what you said. It's exactly that. No, obviously, all jokes aside, there are many beanbags, there are many chai lattes, and definitely 20-year-old billionaires as well. Basically, what makes Silicon Valley so unique is that there are just a ton of people who come together who all want to work on some innovative things and want to push things forward. So, comparison to many other places in the world where I've lived, it is very normal that people just want to work on weekends or meet on weekends for hackathons or build something new or discuss AI or similar things and innovation all around. In big contrast as well, that Silicon Valley is one of the few places where you definitely see more Teslas than Mercedes or BMWs on the street. And so that is obviously a stark contrast to other places in the United States where it's obviously a lot of showing your wealth. And when you're going to a party, basically, instead of bringing a Rolex or anything else, everyone basically brings their brain. And so you very quickly detect there who is doing something interesting. And basically, that is a big part of Silicon Valley.
Well, let's jump into our topic, Felix. You've been talking for the past couple of months about 2024 being a record year for venture capital investments. Now, before we get to that, could you put simply for us, what is venture capital? What are venture capital investors? What do they do? How does the whole system work?
So, in summary, venture capital is basically the earliest stage of private equity. And so, when you consider public markets, you have on the one hand public markets, yet you would be, for example, the stock market where everyone can basically invest in. And then you have private markets, so companies that are not listed on the stock exchange. So, private market is usually private equity. In private equity, you have later stage private equity. So, you would say a couple of 100 million deals. And then you have venture capital. And venture capital is really focused on very, very early stage companies. Early stage companies could be everything from no valuation to potentially a few $100 million valuations. So, in summary, venture capital is just a part of private equity that is investing in very early stage companies. And so, what makes venture capital so unique in its term is that it has a very high risk profile, meaning the investments you take in venture capital are definitely not certain, and many of the early stage companies die. But obviously, the risk and reward ratio is extremely high, meaning if you are one of the earlier investors in very, very early stage companies, and one day the company you invested in a very early stage angel round, for example, becomes a unicorn, so a company that is valued over $1 billion, then you obviously made a tremendous amount of money with this company. The problem, or like not the problem, but the risk obviously on venture capital is that more companies die than unicorns are basically born. And so that is really the I would say, very unique part that just the majority of the investments simply fail.
Now, I've got a couple of questions, Felix. You mentioned the term unicorn. Could you put that term simply for our listeners? But also, more specifically, how does funding work in terms of, you mentioned a number of different Series A, Series B funding rounds. What are these terms and what is this process like?
So unicorns are just simply companies that are valued over $1 billion. There's well decacorns, that would be a company that is valued over $10 billion, but unicorns is usually the kind of status every company want to reach at some moment. The valuation is usually assigned through investment rounds. And so we have different kind of, let's say, stages of investment rounds from the very, very early stage to later stage investments. Usually when the co-founders come together and build a new startup, then they're usually seeking angel investment. Angel investment or business angels are usually private individuals that invest their personal capital into young companies, into startups. At this stage, usually the founders as well reach out to their friends and family So that is a typical check where, for example, their cousins or any other family member is providing $5,000, $10,000, 15, something along that line. And then angel investors are usually providing some similar amount of money. You have as well super angels, so basically ultra high net worth individuals that could potentially provide a little bit bigger check as well to the company, but it's usually along that line. This is called basically an angel round or friends and family round. Afterwards, after angel round basically was closed, the company would usually have some capital to validate their idea. Validate their idea means go out there and basically speak with their customers or with their assumed customers, because when a company is that young, many things are changing, and very often as well the customer profile and ideas can change, which again is called pivoting. But again, to put it simply, it's basically just changing their ideas and their target markets. At this moment, when the company then validated their ideas and knows right now, okay, cool, we know right now what kind of tech we can build. We have a problem really identified. We know as well the customer who could potentially pay for it. They would traditionally go into a pre-seed round. Pre-seed rounds are, as the name states already, a round before a seed round. And so pre-seed rounds could be around $800,000 to $1 million, sometimes even a little bit more, and usually on a $5 million to $8 million valuation. Usually after pre-seed round, when the company then starts, has the product development already full ongoing and acquires the first customer, makes the first revenue, they would usually go into a seed round. A seed round is basically, or was until a couple of years ago, the first round where you would meet venture capitalists. So institutional investors, institutional capital that would invest in early stage startups. Right now, for the last couple of years, we see as well many investors or many VCs investing in pre-seed rounds, but traditionally it usually had started always at a seed round. And a seed round is basically just to provide more capital to the company to acquire more customers and to build a better product and to extend their feature set. And then afterwards, you would basically go up the rounds. Means after a seed round, you would usually get a Series A, then afterwards a Series B, Series C, Series D, and Series E, and so on, until you basically have at some moment an exit, which could be a merger and acquisition. So your company gets acquired, or you potentially would go for an IPO, so initial public offering, and offer your equity basically at the stock market, have a public offering.
It's interesting, Felix, that the talk of the last 12, 18, even 24 months, the post-COVID era, right, has all been about interest rates and inflation and cost of living and economic outlook, etc. What's happening in contrast in venture capital?
You really mentioned some interesting parts, especially the interest rates, and how basically the whole financial ecosystem in the private equity market is basically playing together. Each private equity firm, and again, like venture capital is part of private equity, has investors themselves. They're usually called limited partners. Limited partners could be, for example, sovereign wealth funds or pension funds. So basically, tremendously huge funds that need to allocate their capital for a respective year or for a respective fund. And so if, for example, one of these LPs is sitting on $1 billion or has $1 billion to deploy, then they would look into different kind of risk factors. They would, for example, put some of that money into a public market, so stocks, for example. Other money goes, for example, in bonds. And part of that whole capital allocation would go as well into alternative assets, private equity, and then as well venture capital, which is usually just a very, very small amount of their allocation. Now, these massive funds, thanks to the increase in interest rates, they have obviously a lot of other great deployment targets where they could put their money. So these funds obviously know that venture capital is a very risky investment class or asset class. And they would usually say, okay, we have a certain kind of risk assigned to it. So potentially some funds will not return any money. And now we have very, very high interest rates. So potentially we get even more money in a much more safer investment. And so many of these LPs or limited partners, which would usually put money into venture capital funds, were not deploying money into venture capital anymore because they found really great other places where they can basically put their money and basically generate a return. An increase in interest rates is usually not helpful for private equity and venture capital. So that is one of the factors that definitely made the fund investments or the fundraising for venture capital funds more difficult. And then again, if venture capital funds cannot raise any money or have trouble raising money right now, they obviously don't have capital to deploy that into startups. Another one is basically the last couple of years where we saw extreme volatility in the venture capital market. And volatility, I mean that we saw valuations that were highly irrational. So especially in 2020 and 2021. So for example, you usually had like Series A rounds, which I mentioned before, and were usually inflated by around 35%. Seed rounds similar, about 25 to 30%, meaning startups got much higher valuations for the companies that not particularly were any better at this moment. They just got higher valuations, and the investors, VCs, assigned a higher value to these companies. That obviously hasn't led to fantastic outcomes, because at some moment the whole market basically cooled down, and when there is not enough money to deploy anymore, not many VC funds will invest in startups anymore. And that means that there's a founder that raised potentially in 21 on a very, very high valuations, then usually after 12 to 15 months needs more money, and then comes into 2023 and there is no capital in the market anymore. Or like, no capital is extreme, but there is less capital in the market, meaning investors are more selective where they deploy their capital to. And so now you have companies with very high valuations and investors that don't want to put any money anymore into the market. That obviously doesn't work well for founders, means many companies potentially do down rounds. Down rounds is usually a process when a company first was valued at a very high valuation, and then afterwards in the next round on a smaller valuation. That is usually something what founders want to avoid, because it's not a great signal for any investors. Meaning, hey, investor A, you invested 2 years ago in my company at $60 million US, and now today my company is worth $40 million US. That's obviously not great. What we see right now in the market, and that is really a kind of result out of the last year, out of 2023, is many investors didn't invest in startups and basically kept the money in their funds. We have right now a huge amount of money, an unprecedented amount of money to deploy this year, basically in private equity.
Felix, have venture capitalists learned their lesson? I mean, you mentioned that they have a lot of capital at their disposal that they'll be allocating. And we know that in the past, where there's been a lot of money available, a lot of venture capitalists have put in money and endless amounts of money for many startups to burn. Do you see this happening again? Or with the kind of pause in the availability of the amount of funding that's been available, do you think that they've kind of gone away and they're coming back having learnt their lesson?
To be very honest, I think they haven't learned their lesson. Obviously, time will tell. So we will see how the year develops. But overall, I think we're going to see a revival of the 2020 and 2021, simply for 2 factors right now. Usually, when you look into venture capital funds, it's not that they just simply, let's say you have a $100 million fund. It's not that the venture capitalist right now sits for the next 10 years, 100 million, and you know, slowly waits for great companies to come by. And when they see something really great, they deploy the money. No. They have a very short deployment window. And so when we raise a venture capital fund, we need to deploy this capital between 2 to 3 years. So fortunately, we are not in this situation, but I spoke with many other fund managers. And so consider you raised a new fund at the mid of 2022. And you saw already the inflated prices, and you might not really tempted to invest in this time. So you're sitting on $100 million US right now, which your investors gave you to basically invest into startups and to follow your investment strategy. And then comes 2023, where you see, yes, valuations are coming down. Startup needs money, but it's still not an extremely attractive market. And 2023 passes by, and you're not investing as much as you would have, promised your LPs, your limited partners. And at the beginning of 2024, you're already 1.5 years in with your fund, and potentially still have 70 million out of 100 million as dry powder. And so you only have a year left to deploy these 70 million, because that's literally your investment strategy. That's your investment thesis. And that's what you promised your limited partners. And so you have 2 ways right now. You can either speak with your limited partners and explain them the situations, obviously understand what's going on in the private market, and you potentially a little bit extending your investment horizon. So basically giving you more time to invest, or you're taking 70 million and deploy them in the market in everything, or like in many companies that come along your way and that you find very interesting and that need capital. And so paired with all the capital that we have in dry powder right now in private equity, it could potentially be another market where investors have a lot of FOMO, so fear of missing out, paired with all the development in AI and all these super interesting applications that are coming along our way. It might be potentially a market where investors or VCs are more tempted to invest in companies, potentially even on higher valuations, pushing higher valuations just to get into certain deals and really flood the market one more time with a ton of capital. And so I really hope that we like that everyone has learned the lesson, but I don't believe in it, to be very honest. I think we're going to see a revival of 2020 and 2021.
A bit of an outlook question now for you, Felix. When you have a look at the next 12 months, where do you think funding will be going, in terms of the next generation of unicorns? Which sectors or products or services? What's the thing that we should keep an eye on?
The money will all go into AI applications, 100%. So we see a ton of really interesting applications as AI native companies. So, for example, we see companies that develop their own LLMs, so large language models. And so we put it simply, they are the big players right now. Probably many of your listeners have heard about OpenAI before. OpenAI is basically one of these large language models, or have developed one of these large language models. Many maybe have already played around with ChatGPT as well. And so we see right now many companies developing their own LLMs, which are really fantastic applications. And then we see even obviously many, many more companies that build on these LLMs to enable new kind of technology, which was never possible before. And so my prediction is that not only for the next 12 months, but very likely for the next couple of years, a lot of money will float into AI-enabled and AI-first companies right now that will basically either build something very, very unique with AI, or basically build on the fantastic capabilities of OpenAI, Anthropic, Google Gemini, and other LLM providers.
Felix, you get approached by many companies, I'm sure, on a weekly basis. What are the things that you look out for when a company approaches you, an AI company, when they come to you and ask for your company's support?
Since we're working with companies that are very early stage, so usually when they have an idea, they started speaking with the first customers, or they already started building the product, we require the founders and the core team to have really, really deep understanding of the core markets they are serving. And so it's probably a term many have heard, but we're looking for somewhere an unfair advantage. Unfair advantage means this founding teams know something based out of their previous experience that other founding teams are not knowing. So they understand underlying dynamics in a certain markets they are serving or developing the solution for. That is something we still look at, and that we always looked at, that has nothing relevantly to do with AI, or that an AI basically enables, because it's so deep into the customer need, basically. What we definitely look at is when they work with AI, how proprietary is the AI? Meaning, is that company basically using APIs, which is API is basically digital connection from their company to another company. And so basically, do they just plug into their software into OpenAI, for example, and leveraging OpenAI's capability? If that is the case, then the barrier of entry for other companies, or potentially any single developers, is very, very low, because everyone can plug into OpenAI and potentially leverage their LLMs. And so we're looking into how proprietary their solution actually is, and the AI solution is. If they're developing something AI native, so something that require data scientists, something that cannot be simply copied by a development team over the weekend, then this is obviously a big plus for us, for sure. On the other hand, as well, on the terms of AI and what we are seeing a lot, we see an extreme acceleration in terms of how quick companies develop market-ready products. So I remember very vividly at the beginning of January, we saw, that was actually in November last year, we saw a funding round of one AI company. I don't want to name anyone right now, but basically we saw one AI company that raised this tremendously huge seed round. So a seed round of around $60 million. And so quickly going back to the funding rounds we spoke about before, usually seed rounds are between 3 to 5 million, and this respective company raised 60. So, underlining as well a little bit what we said before regarding the fundraising madness we potentially can see this year. That was November last year. This company still is, it's live somehow. So you see the website, you can pre-register for the product, but there's nobody who's really using the product right now. They still have raised so much money. Then we saw exactly the same application applying to basically our program and to our firm about a month ago. Exactly the same thing. Like 100% the same application, same customer base, very similar pricing as well. And so this founder team worked on it for months. And so I was already blown away by how quick another team can build up the same solution that works. So we saw obviously the demo and the prototype, and it actually worked. And we were considered investing in this company, and we really liked what they're doing. And then I was last weekend on a hackathon. Again, Silicon Valley, people don't go out on the weekends and enjoy the sun. They go in an office and build something together, which is cool. There was a team of 3 developers, which within 6 hours developed exactly the same company, the same use case, and it worked. Okay, there was no website, there was no fancy branding, there was no logo, there was no catchy name or cool AI domain, but this team of 3 people on a weekend in San Francisco built exactly the same what another company has built before for a year and raised $60 million on, which is just mind-blowing to me.
You've done a great job of covering a lot of ground, Felix, and I think let's finish off with a bit more of a lighthearted question. Now, I used to do a little fishing, and in fishing we have the term "the one that got away." Just wanted to ask you. You must have looked at dozens and dozens of business plans and ideas from aspirational startups. Obviously, you can't take them all, but has there been one that you rejected or not, or that you haven't taken on board that's made it really big? So effectively, the one that got away for you.
Indeed, there is one company that got away, but not because we rejected them, simply because we were a little bit too slow. So it was a fantastic learning for us not to act much quicker and to work at the same speed like our AI and startups. So we saw one company and they basically applied to our program. We really liked the founder. The founder, I think, had a really great impression of us. We liked as well the product. That they did something incredible in video AI, basically. So potentially that market could be interesting for game developers, for film studios, for everywhere where you see basically really great visuals. That company developed just something really, really groundbreaking. And our mistake was basically that we were like just wrapping up the first fund. So we nearly had everything raised and we were basically just ready to deploy capital, and not didn't answer, but we're not in touch for like a week or 10 days with the founder, and then wanted to follow up. And then we didn't hear from the founder anymore. And we really asked us, like, what was going on? Like, why don't we reach this founder anymore? And everything was good and we liked each other. And then we saw about 3 weeks later that they got a massive funding from Andreessen Horowitz, which is like the leading venture capital firm in Silicon Valley, which potentially then reached out afterwards. And so that is definitely a company that got away, not only because co-investing with Andreessen Horowitz is obviously a great honor for our firm, but as well because we really liked the founder and the product they were developing. And so yeah, that's one I would say that still hurts a bit.
Felix, this was one of the more difficult episodes, I think, of Put Simply, because of the incredible, complicated nature of the world that you operate in. You've done a fantastic job. Thank you so much for your time.
Yeah, thank you so much for having me, Erdem and Ozan. Really pleasure speaking with you and to being on Put Simply. Can't wait to see you guys next time around.
And that's been this week's episode of Put Simply. Be sure to follow us on LinkedIn at Oroku Group to stay up to date with all the latest episodes and news. Feel free to leave a comment and suggestions on what you'd like to see featured on the podcast as well. Until next time, I'm Erdem Koch.
And I'm Ozan Ibrahim.
Thanks for listening.